The question, I think, is one way to think about policy is how you balance risks. And things have maybe changed a little bit since we last talked and since November. Tell me how you judge the balance of risks between inflation potentially coming back or stalling and potential weakness in the job market.
Well, maybe I should start on the positive side, which is I think inflation's come down a bunch, and I'm encouraged with where it's headed. I think a lot of people on the labor side were worried that there was a cliff there, and that also seems not to be the case. So in both sides of our mandate, we seem to be heading in the right direction. Now, today is no promise of tomorrow, and so you have to think hard about where you're going. And I see positives on both sides, but I definitely see risks on both sides. On the inflation side, we talk about the progress, but we're still in the mid-twos, not at 2, and so we're still above our target. That's a risk. On the employment side, you can't ignore last month's jobs report, even if you try to explain it away. 12,000 jobs is not good. We'll get another jobs report on Friday. And, there is risk when hiring's down in this country that eventually job growth starts to slow. And so both of those are risks, and I'm attentive to both of them.
The chairman talked about this notion of recalibration that, to me, and everybody has their own interpretation of that, basically talked about adjusting the policy rate somewhat separate from the data. Are we still, well, first of all, do you agree with that interpretation? And second of all, are we still in a recalibration mode where you're adjusting to get to a point where you are sort of closer to neutral?
Well, in our September meeting, we cut rates for the first time. And to me, the logic was pretty straightforward, which was inflation was a lot closer to target. Unemployment was pretty close to what most people think is maximum employment. And the one number that seemed out of sync was the Fed funds rate, which was, depending on how you think about neutral, 200 or plus more percent points over what neutral was. And so the notion of recalibrating the Fed's fund rate made sense to me, and I do think that's the process. So that's your second question, I guess, which is, did that make sense to me? It is a judgment call when you're sort of done with recalibrating and ready to start normalizing. And to me, normalizing is a slower, more careful path to try to bring rates down to neutral. And I think that depends a lot on where you think neutral is. It's like a unicorn that no one's ever seen because you can't measure it. Even the best models have a 200 basis point standard error. And if you look at the FOMC analysis, we have people as low as 2.5 and people as high as 3 3/4. And so it's pretty hard to know that, but based on where you think that is, that's one determinant. And the other is where you see the risks. And so even in the next couple of weeks, we'll learn a lot more. We'll get another jobs report. Is it going to be more like November or more like October? We're going to get another whole round of inflation data. Will it look more like the 12-month numbers or more like the last couple-month numbers? So there's a lot of information still in front of us.
I get that, but I guess the question remains, are we still recalibrating? Are we still coming down because you need to be in a place that's closer to neutral, irrespective of the data that's coming up?
Well, that's the judgment call we're going to have to make. And I think it really does depend. I think the story that says we want to get to not very restrictive but somewhat restrictive, because we're not yet at our mandate, but we're a lot closer than we were, that story is very clear. I'm sure my colleagues will have very different points of view in terms of what is somewhat restrictive enough.
All right, we're going to come back to that, but I just want to ask you about how do you process the potential changes in fiscal policy that could be coming?
We released the CFO survey this morning, which Richmond does with the Atlanta Fed and Duke University. A pretty interesting set of outcomes. The CFOs in that survey, and if any of you would like to participate, we're open for business. We did the survey before the election, half the survey, and half the survey after the election. And what you saw was the business leaders in that survey significantly more optimistic about the state of the U.S. economy, significantly more optimistic about growth. And that's
Barkin with our Steve Liesman at the CNBC CFO Council.